Business Books presents 50 Tips from the book, The Intelligent Investor. Invest in stocks with a margin of safety, meaning that the stock is undervalued or has a low PI ratio. Don't try to time the market, but rather focus on long-term investing. Invest in companies with a history of consistent earnings growth. Don't rely on stock tips from others. Do your own research. Diversify your portfolio across different industries and asset classes. Avoid stocks that are overvalued, even if they are popular with the market. Be patient with your investments. Don't panic when there are short-term fluctuations. Use dollar cost averaging to invest regularly over time. Invest in bonds as well as stocks for a balanced portfolio. Avoid investing in companies with a lot of debt. Pay attention to a company's management team and their track record. Keep an eye on a company's dividend history and payout ratio. Use fundamental analysis to assess the value of a company. Avoid stocks that are too small or too illiquid. Don't invest based on emotions such as fear or greed. Be wary of companies that have a lot of goodwill on their balance sheet. Look for stocks with a high dividend yield. Keep an eye on a company's price-to-book ratio. Avoid investing in companies with too much inventory. Stay away from companies with a lot of intangible asset. Avoid stocks that are highly cyclical. Don't invest more than you can afford to lose. Be prepared to hold onto your investments for the long term. Invest in companies with a competitive advantage. Don't rely on past performance to predict future success. Pay attention to a company's cash flow and debt levels. Look for companies with a low PEG ratio. Avoid investing in companies with a lot of deferred tax liabilities. Stay away from companies with a lot of goodwill write-offs. Don't invest in companies that are too dependent on one product or customer. Keep an eye on a company's gross margins and operating margins. Avoid companies with a lot of long-term debt. Pay attention to companies' return on equity, ROE. Don't invest in companies with a lot of outstanding options or warrants. Look for companies with a high return on assets, ROE. Avoid investing in companies that have a lot of short-term debt. Be wary of companies that have a lot of off-balance sheet liabilities. Keep an eye on a company's earnings per share, EPS. Look for companies with a low price-to-sales ratio. Avoid investing in companies with a lot of litigation risk. Don't invest in companies that have a lot of pension liabilities. Look for companies with a high free cash flow yield. Avoid investing in companies with a lot of contingent liabilities. Be prepared to sell your investments if the fundamentals change. Look for companies with a low price to cash flow ratio. Avoid investing in companies that are heavily regulated. Pay attention to a company's inventory turnover ratio. Look for companies with a low debt to equity ratio. Avoid investing in companies that have a lot of environmental liabilities. Be disciplined and patient in your investing approach.